Hey everyone, it's PJ Patterson here for a market update. Today is the 29th of May. It's Friday. So happy Friday to everyone. I hope you're looking forward to a good weekend. Looks like we're going to have some relief from all the COVID restrictions that have been put on over the last couple of months. And I think with a relaxation of those starting June 1st. So I think cafes, restaurants, and other things are already opening up, which is great. And I'm going to talk a little bit about that today and what that means. My three things today, I'm going to sort of continue on this educational path of giving you, more and more information about how my process works now, and what it means and what the market is telling us with its recent activity. So my top three things today are, first of all, I just want to revisit the idea of preservation of capital, particularly in a bear market. The second thing is going to be talking about correlations. And then the third thing will be talking about the cycle, where we're at in the cycle, and some of the information that we've received in the last 24, 48 hours that's going to probably help you put into perspective what's been going on in the market. So first thing I thought I'd touch on is the fact that we are in a bear market. We continue to be in a bear market. I'm just going to see if I can pull up a chart here of the, while I'm still sort of on the screen as well, of the S&P 500. Actually, that's going to be a bit tough to do. Sorry, guys. While I'm getting this chart open, the point that I want to make about the S&P 500 index is that the bear market that we have been in for the better part, sorry guys, this is not working as well as I wanted to. Come on, open up. I want you open. There we go. Sorry, everyone. The chart of the S&P 500, I'm just going to get to daily candles here. My goodness, it's Friday. Everything is running slow. Looking forward to the weekend. Okay, here we go. This is a slightly longer term chart. So what you can see here is we had, sort of the top here back in early Feb, I guess, mid-Feb, whatever, of this year. And then an absolute, cascade lower through March when COVID hit and they started shutting the global economy down. And we've had probably now, it's hard to say for sure, but this is probably about a 55 to 60 odd percent, maybe 62%-ish retracement of this down move. Now, this is a classic bear market bounce. I'm just going to come back to the screen here. This is a classic bear market bounce. And what it means is that the market is trying to price in a V-shaped recovery. They're trying to price in the economy restarting. They're trying to price in, asset price inflation, but it's going to fail. And this is, again, classic bear market stuff. And the point I want to make, particularly around preservation of capital, is that when we're in a market like this, where the global economy is shut down, 40 million people in the US are unemployed, probably more are underemployed. We'd have a similar circumstance, probably on a proportional basis, in Australia. We got a pretty sort of average unemployment number in the last report, but that didn't really capture all of the stuff that has been going on the last couple months. So we've got, for example, GDP report coming up for Australia, I think June 5th. Anyway, the key thing as an asset and money manager for me is item number one is always to preserve capital and not lose money on a net basis. Obviously, there will be losing trades. No one can be 100% right all of the time and never, ever lose money on an individual trade. But overall, we want to be preserving capital and making sure that we're not getting, particularly in these big market downturns, totally, wasted by the market. So as an example, all of you are already well in front of your peers because you didn't have the market crash hit your portfolio accounts, or your portfolios, I should say. Whereas your peers are still arguably down 10, 15, maybe 20% from the highs. Now they're feeling good right now because the market is recovering, or it seems to be recovering, and they're thinking, "Oh yeah, I'll be able to get back to back to even." But as I've stated before many times, when you have a big drawdown of capital, for example, a 10% loss of capital is going to require a 12, 13, 14% increase to get back to even. And of course, the further out you go on that x-axis in terms of percent losses, the more you have to have in terms of percent gain to get back to even. So we're nowhere even near that, right? So I don't know why people are getting all funny about it at the moment. And I guess the mainstream media tries to talk up, these things, which is their job to be a cheerleader. But again, I just want to remind you that my primary goal, especially in bear markets, because bear markets are really, really difficult. They are really difficult. They don't come along very often, and they're brutal. And what we're about to see, I think, in the coming weeks is we've had this nice run in the S&P 500, the Russell, and a few other markets. And I suspect that's going to roll over. So I'm giving it a time frame of probably the next 4 weeks or so. And the reason for that is we're going to see some data, and I'll talk about that in a second when I talk about the cycle. We're going to start to see some data that's going to be positive, and then it's going to roll over again. So I'll come to that in a moment. So that's preservation of capital. So please just remember, if your accounts aren't moving up a lot and you feel like you're missing out on all this stock market rally, just remember, you're not down 30% from where the high was. You're not, waiting to get back to even so that we can move ahead. You're actually, you've done well not to lose money and actually make a bit of money during all of this. So don't get caught up. And I use the term FOMO a lot, fear of missing out. Don't get caught up in the FOMO. Just check that at the door. This bear market has a long, way to go yet. And this whole situation has a long way to go yet. So item number 2, correlations. I've been reading about and studying more about correlations. So when something is correlated 1-to-1, it means that in stock market parlance, it means that for every, say, if the S&P 500 is correlated 1-to-1 to the US dollar, it means as the US dollar moves up, the S&P 500 moves up at the same time and commensurately moves down at the same time. When something has a negative correlation, it means that if that thing goes down, something else might go up. And then if it has a correlation that's slightly positive or whatever, it means that perhaps if the S&P 500 goes up 100 points, something else might go up 50 points if it's a 0.5 correlation. So obviously you get the gist of what I'm saying there is that things are related and certain things move at the same pace if they're going up or going down. And so when you think about the universe of asset classes, so one of the things that I've brought to the table this year for all of you is now an exposure to and trading things like the currencies, obviously gold and the gold miners. We were able to do that before, but now it's a little bit better. But also a whole nother universe of sector and even style factors. So when I say sectors, I'm talking about healthcare and energy and technology, that sort of stuff. Style factors would be things like high beta stocks, low beta stocks, all this sort of stuff. I'm not going to get bogged down in that. But one of the things I want you to understand that I do is I look for a way to balance a portfolio so that hopefully there are not a lot of correlations, because what happens in a bear market typically is, just about everything goes down. Not always. We've had this bear market, we've seen treasuries and gold going up as the general market has been going down. So again, that would be where there'd be a negative correlation. As the stock market falls and equities fall, we've seen treasuries go up and gold go up. But there's also the dynamic, and I talk a lot about this as well, the dynamic of volatility. So there's a number of dynamics at play, right? It's not just one thing that I look at to say, there's the answer, and that this is now how we're going to trade these markets. But again, that relationship or correlation is very, very important, because what you're finding right now, as an example, is the Aussie dollar has been kind of strong. And so, and equities have been strong. So other investments like gold and treasuries, they've come off a little bit. But what we'll see, I think, in the coming weeks is we'll start to see, and especially I think it's going to happen when the GDP number comes out for Australia. And if we see continued tension between, you can see it up on the screen right now, the US and China, tensions are beginning to build again. That's going to take some of the wind out of the sails of the market. So moving on to just to lock off correlations. The final point I want to make on this is, for anybody that has an industry fund, right, or is invested in a platform and has a portfolio of stocks broadly speaking. Your correlation is almost going to be 1-to-1 in the sense that if the market is shitting itself, your portfolio is going to be shitting itself. And one of the reasons for that is a lot of the managers are unable to pivot to things that are outside of their mandate. Well, actually, they cannot pivot to things outside their mandate. So, as an example, if you have an Aussie stock fund or Aussie share market only managed fund, those guys cannot get out of the market 100% and go to cash because their mandate doesn't allow it. So the best they could probably do is go to 10% cash or something like that. And so they're going to get really crushed if the Aussie stock market gets crushed. I hope that makes sense, correlation stuff that I'm telling you. So anyway, it's one of the things, along with a number of other things, that I look at to help me make investment decisions for us. Pardon me. The final thing I wanted to just touch on is the cycle. And at the moment, as I said, just looking back at this chart here of the S&P, and many other charts would sort of look like this. They've had a sharp decline, and they've had and not, that's not a sharp recovery. It's not straight up, but it's pretty close to it. And that is because, and I think I've commented about this before, a lot of people expectation is that the market's going to recover quickly because that's what it's done in the past. So there's this thing called recency bias. And when I say recency, I mean we've had some sharp sell-offs, the last of which, of course, was the GFC in 2008. And it did take a while for that market to recover, but of course it did recover reasonably quickly. But then it crashed again, right? So I'm not going to try to find the slide right now, but one of the slides that I have shown in the past is a history of the bear markets and the depressions and things that have occurred over the last, say, 100 years. And we are 4 or 5 months into this bear market, if that, right? Might even only be about 3 months into this bear market. We have got a lot of time and space between now and the end of this bear market. So actually, one slide I will show you is this slide, which I often do show, which is from the Hedgeye. It's on the U.S. quad. This is a U.S. quad map. Sorry, get the words out. And here we are, deep quad 4, right? We are deep in quad 4. This is depression territory. And all of this stuff, all these blue dots up here mean very little at the moment. We're not headed up into quad 2 anytime soon. The data is tracking there because of comparisons between what's happening expected to happen in the third and fourth quarter based on comparisons to the previous quarter last year. So that's going to change, though. This will all change. And in fact, what we'll probably see is this 3Q20 drop down. So the E means, sort of estimate, but it's going to drop down here into quad 3. And we'll probably be in quad 3 for a few quarters. So the quad 4 and deep quad 4 is basically depressionary environment, and we're moving more into a quad 3 recessionary environment. So before everybody gets their knickers in a knot over, FOMO and all this sort of thing, that's where we are right now. We are moving from arguably what is a depression. So again, we have 40 million people in the U.S. unemployed. There weren't that many people unemployed in the Great Depression. Of course, the population of the U.S. was much smaller, but nevertheless, we haven't seen numbers like this ever, right, in the history of the tracking of the numbers. Furthermore, the highest unemployment that occurred during the GFC in the U.S. was 6 million people. We're at 40. Right? We're not even in the same postcode as the GFC back in 2008. So again, these things need to be put into context and perspective. So one of the things that the reason I've got this earnings slide up is because, again, I continue to harp on earnings. And the fact that, this quarter or this earnings report that we saw, earnings season that we've seen in the last month, we're showing earnings growth declining 7.7%. Pretty much all the S&P companies have reported. The financials have all reported, and theirs is horrendous, and it's only going to get worse. And other sectors are also equally as bad. So again, this is not done. We're going to see continued quarters and months of bad earnings reports, and the market's going to have to adjust to that. And again, it's not really pricing that stuff in. So a lot of people are, once again, thinking the Fed has ridden to the rescue and has rescued the stock market. That is not going to, I don't think anyway, that is going to play out over the next, let's say, 6 months. I think it is going to be worse. What else did I want to show you guys on something? Yeah. Oh, the other thing, sorry, was that Asia is pricing in some serious, badness going on. The thing about what's happened in the U.S. is it hasn't happened anywhere else. We haven't seen this massive bounce in stock markets in Asia. As a matter of fact, they're still plumbing sort of the lows. Hong Kong is getting smoked. Shanghai index is getting smoked, continues to get smoked. The Kospi, which is the South Korean stock index, continues to get smoked. So again, the reality is that we have the U.S., and it's very unique, this FOMO that's going on in the U.S. versus the rest of the world. The rest of the world kind of gets it. As I said, Asia's a mess. Europe is a mess and continues to be a mess. They're talking about more stimulus and doing more to pump up the economy and the stock markets there. So just coming back to the final point, which is the cycle. We are still in the throes of a depression situation, moving again to recession. We have corporate earnings that still we haven't fully seen the impact of COVID on corporate earnings yet. And we are not going to see employment rip back up to where it was, the level that it was at. And this is in the US, and I dare say Australia as well, most of the world, in fact. It's not going to go back to the level that it was at prior to COVID showing up. So it could take years for us to get back to having those 40 million jobs not replaced, but put back on. So again, there is a lot of pain to come, and then there's all these other little latent things that are bubbling under the surface. Like, what happens now with the economy restarting? Are we going to see a resurgence in COVID cases, and what will they do about that? That's number one. Number two is how quickly will employment? I've already discussed that really, but how quickly will businesses put employees back on? When restrictions are lifted, what will be the impact to things like restaurants and other businesses that require a lot of traffic to make money? We just don't know that yet. Furthermore, we just don't know how the economy is going to respond. We've seen the Fed throw a ton of stimulus at the market. They're now talking about buying stocks directly, which is a very dangerous and slippery slope to go down. Japan has been doing this now for the past at least 3 to 4 years, perhaps longer. Their market continues to languish, and their economy continues to languish. It's called a zombie economy. So I guess ultimately what I want to close with is that just temper your enthusiasm. If you are concerned about missing a market bottom, just check that at the door and temper that, because you haven't missed anything. There's still a lot of pain to come. And you'll know, you're going to know it, because about that time, I'm going to be saying it's time to buy. And you're probably going to feel like, oh my God, this is the worst ever. We don't want to buy stocks right now. But that'll be an interesting contrarian indicator, actually. Anyway, I do hope everyone is coping well. I know I've had conversations with a number of my clients about what's going on in their world with reduction of salaries and businesses that have had to shut. And I know that's not a good situation at all for anybody. But the reality is that all of these things do pass, and they come to pass. Hopefully, they just pass and come to pass before you run out of capital, right, and have to really take extreme measures. So if anyone is hurting and needs to have a chat to me about release of super or anything of that nature, please do not hesitate to give me a call. That's why I'm here, to help you out, to help guide us all down this journey of navigating markets. But I do think, and I can see signs that later this year, early 2021, sort of first quarter, that's probably when we're going to see things begin to thaw. In between now and then, we're going to see a lot of fits and starts. So again, just just know that there's going to be a lot of whipping around in this market. And as I navigate the bear market, what I'm going to be, again, focusing primarily on is preservation of capital. Because when we get to the clear skies again and we resume, we get into quad 2 or quad 1, it's going to be a ripper. And the cool thing about it is you'll have all your capital intact and you'll already be 20 or 30% ahead of everyone else, if that makes sense. So guys, have a good weekend. Thanks to everyone for all your support. And please put questions, comments in the boardroom and keep that stuff coming. Don't slack off on that. You guys have put a lot of great questions and things out there, and I really appreciate it. And again, if anyone has any problems, questions, or concerns that you need to speak to me about, please do not hesitate to give me a call. Once again, have a wonderful weekend, and I will talk to you soon.